sharply. Can Bitcoin protect you? Today we test the true safe haven. Exploding debt, higher for longer risk, liquidity swings. When the world wobbles, what truly holds? Gold has history, Bitcoin has math. One is tangible scarcity, one is programmed scarcity. And the results may surprise you. We will use real stress events, correlations, and drawdowns. Stay to the end for a portfolio mix that improved my Sharpe by 12%. Safe haven equals negative correlation during equity stress and a credible inflation hedge. Add low drawdowns, deep liquidity, and persistence across regimes. In panic, capital flees to where it can hide and exit easily. Correlations compress in crises, true havens decouple. Gold, centuries of trust, central bank demand, jewelry buffer. Bitcoin, 21 million cap, globally transferable, no counterparty. Both check boxes, but to different magnitudes and timelines. From 2022 to 2024, they moved together. Early 2025, that broke. Gold reasserted risk-off behavior as Bitcoin tracked risk assets. Inflation hedge means holding purchasing power across cycles. Gold responds to rate paths and real yield shifts quickly. Bitcoin's hedge works over longer arcs, with higher interim volatility, shallower gold drawdowns, fatter upside tails for Bitcoin. In capital controls, portability matters. Bitcoin can shine. The thesis: safe haven is contextual, not absolute. COVID 2020, Bitcoin crashes 60%, then plus 380%. Liquidity vanished, everything sold. Safe haven, not in the initial liquidation. Gold dipped, then stabilized as stimulus arrived. Massive money creation rewired flows. Bitcoin roared on liquidity and adoption. Retail and institutions piled in. Volatility, yes, but upside asymmetry appeared. Lesson: Bitcoin failed the instant shock test, then crushed the recovery. Gold behaved like a classic stabilizer. Policy backdrop matters for both assets. Mandates favor gold. Bitcoin allocations rose from zero. As liquidity returned, Bitcoin de-risked gradually. Stability versus growth, two roles, not one. Volatility gap remained enormous. A safe haven can be safe at different horizons. Short-term, gold. Medium-term, risk-on. Bitcoin excelled. Context defines haven status more than labels. SVB 2023. A modern bank run ignites duration risk. Long bonds, short deposits, sudden withdrawals. Confidence evaporates in hours. While banks burned, Bitcoin recovered 90% from lows. A narrative shift, self-custody, no bank liability. Gold again did its job, calm bid, steady hand, two hedges, two tempos, counterparty risk, minimized with Bitcoin when self-custodied, policy response, backstops, facility acronyms, softer path. Institutions rotated to time-tested collateral. Operational cash moved, treasury policies updated. For a window, Bitcoin decoupled from banks. Gold ETF demand surged during the scare. Stress differentiates assets by counterparty and liquidity. Centralized failure versus decentralized resilience. Aftershocks faded, both assets retained believers. One hedges system trust, one hedges money trust, and that distinction matters. 2026 year-to-date, gold surges while Bitcoin pulls back. Gold holds above 5 grand as markets stay fearful. Bitcoin faces risk-off flows and ETF redemptions. WisdomTree frames them as complements, not competitors. 2025 already showed widening performance gaps. Capital flowed into gold funds as Bitcoin saw net redemptions. In stress, gold attracts institutional mandates first. Overlap exists, but edges differ by mechanism. Low and unstable correlation boosts diversification. Combining them can push the frontier outward. One is custody depth, one is censorship resistance. Multi-regime portfolios need both skill sets. Consensus expects gold strength to persist into year-end. Complementary, not mutually exclusive. Divergent outcomes do not mean redundancy. Bitcoin's edge, a hard cap of 21 million, issuance predictable, transparent, and credibly neutral. secured by roughly $25 billion in annualized hash rate investment. Thousands of independent operators compete to secure blocks. Self-custody reduces counterparty risk to near zero. Risks remain: regulation, volatility, operational mistakes. Gold's edge: universality, deep markets, low variance. Different cost stacks, different frictions. Safest path often blends old reliability with new resilience. Edge is not immunity. Risk sizing matters. My strategy? 5% gold, 3 to 5% Bitcoin. Result? 12% better Sharpe with prudent sizing. Drawdowns contained while upside optionality remained. Beyond 5% BTC, benefits diminish for my risk. Not financial advice. Your constraints and horizons matter. Quarterly rebalancing harvested volatility. Scenario tests favored a blend across shocks. Small, disciplined positions can do heavy lifting. Process beats prediction in uncertain regimes. Gold preserves, Bitcoin multiplies. Which is your safe haven in 2026? Comment below, subscribe for more data-driven breakdowns. Thanks for watching.